Hi guys, welcome to a simpler approach. If you are new to the channel, please subscribe, like, comment and share. Last week, we started double entry. We looked at double entry for assets, liabilities and capital. In this week's lesson, we will be looking at the double entry system for the asset of stock. Let's get started. Our only objective for this lesson is to garner an understanding of the double entry system for the asset of stock. Now, normally, before we dive into the essence of our lesson, we usually cover some groundwork first. We're going to do the same for this section. So, first things first, stock. What is stock? Now, stock, also known as merchandise, also known as inventory, also known as goods, refers to the items that are bought by a firm that are ultimately resold at a marked up price in order to make profit. So if we're talking about a haberdashery, a supermarket, a wholesale, we're talking about rice, flour, tin items such as mackerel, sardines and stuff like that. Those things are bought and then sold again at a profit. Okay? So that refers to stock. That's what stock is. Second thing we must know, purchases. Purchases is a term referred to the process of buying stock for resale. So when we talk about purchases, we're talking about the act of buying stock. Okay? The purchases account. That is the account that we use when stock is purchased. Let me say it again. Purchases is the T account that is used when stock is purchased. Okay? Now, you hear me talking about T account. I hope I'm not confusing you. Remember, we're talking about double entry, the asset of stock. So we're still going to be talking about the confinements of double entry, the intricacies of double entry. All of that are still in play. Okay? Sales. Sales is the opposite of purchases. So sales is when stock is sold. Cool? Now the sales account is the account that is used when stock is sold. The T account that is used when stock is sold. Cool. Return inwards. Return inwards is a term given to the process of goods being brought back to us by our customers. Now, goods can be brought back to us for whatever reason, but whatever the reason is, when goods are brought back to us, that is referred to as returns inwards. Returns inwards account is the account we use when goods are returned to us by our customers. Okay? Returns outwards is the opposite of returns inwards. Now, returns outwards is when goods are returned to our suppliers for whatever reason. And the returns outwards account is the account that is used to record when goods are returned. Okay? Now that we've built somewhat of a foundation, let's start building on it, shall we? Now that we know that what stock is, we can go on to looking at the fact that stock moves in two directions. Stock either comes into an organization or it goes out of an organization. That's it. It either comes in or it goes out. Now, when stock comes in, there are two accounts that are used, either purchases, which means that we purchased it, or returns inwards, which means it was sold before but has been brought back to us for whatever reason. Cool? When stock goes out, it's either sales, which means we sold it, or returns outwards, which means goods that was previously bought by us was sent back to our suppliers for whatever reason. Okay? Now I need you to remember this because this will be critical to the process of breaking down your transactions and determining which of the four you use. Once again, if it's coming in, purchases or returns inwards. If it's going out, sales or returns outwards. Okay? We will be looking at a few examples that will help us to understand a double entry where the asset of stock is concerned. But let us first remember a few things. Number one, all that you have learned thus far regarding double entry remains the same. The rule, the steps, what it is, T accounts, debit and credit, all of that remains the same. Doesn't change whatsoever. That's one. Two, the asset of stock. The asset of stock. You see what I'm trying to say to you? Stock is an asset. So straight away you already have an understanding of what's happening. You're dealing with an asset, which means automatically you should know the double entry rule for it. So when it increases, debit. When it decreases, credit. That should be automatic for you. All right? Cool. So our first example. Bought goods on credit from J. Handel. Now remember our double entry steps. Step one, identify the items affected. Now let me help you out with something. You see that? Those two words, bought goods, it's an indication of the first item affected, purchases. I really don't like giving shortcuts, but I'm going to help you out as best as I can. Whenever you see bought goods, hands down, that's purchases. Bought goods, bought stock. Purchases, and remember we already defined purchases as the purchase of stock. Okay? Cool. So we already have one item down. On credit from J. Handel. Now in our previous video, we spoke about those two words, on credit. Whenever you see on credit, it means you owe for it, which means there's a liability going on right here. Okay? And when there's a liability, you open the account for the individual that the item was purchased on credit from. Therefore, the two items affected here, purchases and J. Handel. Cool? Determine if the items increase or decrease. That's step two. So let's break this down now. Purchases. What is happening with purchases? Purchases is increasing. Why? Because I'm buying stock, which means my stockpile, my stock count is increasing. Okay? Awesome. J. Handel. What is happening there? Liabilities are increasing. Why? Because I bought items on credit from Mr. Handel, which means, assuming that J. Handel is a Mr. Handel, which means that I now have an obligation to him, an increased obligation. Okay? So now we see that purchases increased and J. Handel, liability, also increased. So we've taken care of step one and step two. Step three is to apply the double entry rule. Now, you remember a while ago I kept saying the asset of stock, and I was looking at you like this, and I was saying the asset of stock. And I was asking if you caught my drift. Yeah, I think by now you've caught my drift. Stock is an asset. Cool. And when asset increases, what do you do? See there? When an asset increases, you debit. Someone is thinking, how sir I get that? And you're now laughing because you're saying, oh sir, no, sir, I think that. I've been doing this a while. Remember that stock is an asset, and in addition to that, stock being an asset was bought. So when an asset increases, you debit. Okay? Cool. Now, handle. J handle is a liability. Now, when liabilities increase, what do? We credit. Now, you see the double entry coming out because remember you're supposed to debit something and credit something. So we're now going to debit purchases and credit J handle. Once again, remember that the entire concept of double entry, it remains the same. Nothing changes. We're just adding to the concept. Okay? There we have our two accounts, purchases and J handle. Remember also that purchases is debited, and when we say debit an account, we mean that the information is placed on the debit side, which is the left side. So there we have in the purchases account the information necessary for the transaction. June 3rd, 2012, details J handle, $12,000. And remember, the corresponding item is used as the detail. So when we look at the purchases account, it literally tells us that on June 3rd, we bought goods on credit. J handle is there, which means it was bought on credit. Bought goods on credit from J handle, $12,000. Same thing applies for J handle account. When we look in J handle's account, knowing that liability was credited, and when we credit an account, we place the information on the right side, because the right side is the credit side. So when we look on the right side, we can clearly see that on the 3rd of June, stock was bought on credit from J handle for $12,000. Okay? Hopefully you're starting to see what's going on. If you haven't started yet, let me use this to help you to get there. Example number 2. Bought goods for cash, $8,500. Now, remember what I said about those two words? Bought goods. Whenever you see bought goods, what that mean? Purchases. It's supposed to happen just like that. Bought goods. Oh, purchases. Poof. That's what's supposed to happen. Okay? So straight away, we know the first item affected here. Purchases. Second item, how did we acquire these goods? For cash, which means we paid cash for it. Cash, therefore, is the second item affected. Okay? So our two items affected, purchases and cash. Cool. Step 2, determine if the items increase or decrease. We already know that purchases increased. We bought stock, therefore our stockpile is going up. Purchases has increased. We know that. Cash, on the other hand, is decreasing because we have bought something using cash, which therefore means that our cash amount has gone down. Okay? So purchases has increased, cash has decreased. Cool. Applying the double entry rule. Both cash and purchases, and when I say purchases, I'm affiliating it with stock because, the two are linked. Yeah, you get the point. Both are assets, and because both are assets, this makes it a little easier to, break down. One is increasing, one is decreasing. Okay? The one that is increasing, being purchases, would be debited as per the rule, and the other, cash, which is decreasing, would be credited as per the rule. Okay? Now, when you open the accounts for these, this is what you will find. Now, notice that you see two entries in the purchases account. The first example for June 3rd and the second example for June 7th. Now, I purposely did that to bring across one important thing that you must know. When we were talking about T account, we said everything relating to an asset, liability, capital, whatever it is placed in the T account. That brings us to another key thing that you must know. Only one account per item must be opened. What does that mean? It means that we don't open 7 different purchases account for 7 different transactions. We open one purchases account and place the information there using the date on whichever side it's supposed to go. If it's a cash account, one cash account, all the items are there on the respective side using the respective date. Okay, so if you look in this purchases account, you will see the 2 items there. And throughout the month of June, any other purchases that took place would have been placed in one T account. Okay, now if you're wondering why I didn't tell you that last week, this is a learning experience, which means information is placed on top of each other, one at a time. Okay, cool. Now, back to the issue at hand. When information is placed in the account, purchases on the respective side, which is the debit side, which is the left side, using the date and the corresponding entry. As for the cash account, remember that cash had decreased, and as a result, when an asset decreases, you credit, which means you put the information on the right side, as you can see there. And remember, you use the corresponding item as the detail. Sweet. Example number 3. Sold goods on credit to F. Bryan, 13,900. Now remember I told you about helping you out with a few things every now and again? That's another one of those things. The first one was bought goods, purchases, hands down. This is sold goods, which means sales, hands down. So whenever you see sold goods, we're talking about sales, which means that we would have identified the first item affected. After that, it would boil down to if the item was paid for or if it was sold on credit. If it was sold on credit, it means therefore that we have a debtor. A debtor is someone who owes the business, and debtors are assets. Okay? Awesome. Stick a pin in that part just for a second. So the 2 items affected, sales and F. Bryan. F. Bryan is a debtor. Now we determine if the items increase or decrease. Now, sales would automatically decrease because we are selling stock. Asset of stock is going down. That's an automatic decrease. F. Bryan would be an automatic increase because F. Bryan is a debtor. We have now acquired a debtor. Okay? F. Bryan now owes us for the goods that we sold him. Okay? So, sales decrease, F. Bryan increase. Now we head to step 3, where we apply the double entry rule. Now, sales speaks to asset of stock being sold. So we've identified that stock being an asset is decreasing, and when an asset decreases, we credit. Okay? As for F. Bryan is a debtor. Debtors are assets. This asset is increasing. When an asset increases, we debit. Okay? When we would have opened the accounts for these 2, it will look like this. Now you see that F. Brian's account was debited. And remember, when we debit an account, it means that we place the information on the left-hand side using the corresponding item as the detail. As for sales, I'm going to give a little heads up. Sales is always credited, okay? Because you're selling stock. Asset of stock is going down. You credit. And the opposite is for purchases. Purchases is always debited for now. Okay? Cool. So with sales, credit the sales account. And remember, when we credit an account, it means that we place the information on the right side using the corresponding item as the detail and the date. Okay? We have about 2 more examples to go, and that will be it. Example number 4. F. Brian returned goods to us 1,200. Straight away, we can identify the first item affected, F. Brian. Okay? Now, as for the second item, look at these 2 words. To us. To us means what? Goods returned to us. That means returns inwards. Because it did say that the goods were returned to us, and by us in this context, we mean the business. Okay? And we already know that goods returned to us is referred to as returns inwards, which means that goods were previously sold to F. Brian. And yes, in the examples that we have been doing, we did sell goods to F. Brian. Now, whatever the reason is, probably it's faulty, probably we sold him the wrong thing. Whatever the reason, he has sent goods back to us. Okay? So the 2 items affected here are F. Brian and returns inwards. Cool. Step 2. Determine if the items increase or decrease. Now, F. Brian was a debtor, okay, or is rather a debtor. Now, his debt to us would decrease because the value for this return would not be charged. We will not charge him for it, which therefore means that his debt would decrease. Okay? For returns inwards, goods are coming back to us. And that by itself would mean that returns inwards, stock is going up. Okay? Now, for the double entry rule, both items are assets. If Brian is a debtor, debtors are assets. Stock is coming back in via returns inwards, stock is an asset. Okay? It's just that one is decreasing and one is increasing. Now, F. Brian being the debtor is decreasing, and when an asset decreases, we what? We credit. As for returns inwards, which is stock, when stock increases, debit. Why? Because stock is an asset. Cool? Now, when we open the accounts for these 2 items, they would look like this. Also, if you look carefully, you would recognize 2 items in the F. Brian account. Okay? Now, remember we did say, when I was showing you the purchases account a few minutes ago, that T account, the concept of T account is that everything relating to an item is placed there on whichever side using whichever information. Now, this is what F. Brian account would look like using all the information pertaining to him so far. So on the 18th, we sold him goods, 13,900, and then on the 24th, he sent back some of those goods to us. Okay, now this, once again, is bringing out the concept of 1 account per item. So I would not go ahead and open another F. Brian T account to put information in it. That would be chaotic because you would end up having multiple accounts of the same item spanning multiple dates. That would be chaotic. Okay, so remember now, 1 account per item, and you just place the information there on whichever side. Now for this example, F. Bryan account was credited because his debt to us is decreasing. And remember that when we credit an account, it means that we place the information on the right side. Okay? As you can see there in F. Bryan's account, with the corresponding item being the detail, with all the other information necessary. On the flip side, we have the returns inwards account that was debited. Why? That reflects our asset of stock coming back in. And when an asset increases, you debit. Debit means you place the information on the left side, as we see there, and we use the corresponding item as the detail. Our final example, we returned goods to M. Maverly, 2,100. Now, you see that little section there? We returned goods. It tells us the direction in which the good is going. So, returned goods to us, in. We returned goods, out. So we can literally use the transaction to tell us the direction of the goods. Okay? And where return is concerned, if it's going out, it will say we returned goods. And if it's coming in, X or Y returned goods to us. Okay, cool. So straight away we can see here that the first item affected is returned outwards. Second item, who did we return goods to? M. Maverly, 2,100. And that would be the second item affected. So that takes care of step 1. Step 2, determine if the items increase or decrease. Returns outwards would signify a decrease in stock because we are sending back stock to our suppliers. So stock is going down. Okay? So that reflects a decrease. M. Maverly would also reflect a decrease in liability because in the same way when F. Bryan, our debtor, had sent back goods to us and we don't expect to charge him for it, it would be the same way that when we return goods to M. Maverly, we are not expected to pay for it because we have returned it. Okay? So our liability to M. Maverly would have decreased. Okay? That takes care of step 2. Now for step 3. Returns outwards is naturally stock. Stock that is going down. And when an asset decreases, you do what? You credit. Okay? And for M. Maverly, being a liability that has decreased, when liabilities decrease, you debit. Okay? And when you have placed these in their T accounts, it would look like this. M. Maverly account, remember that M. Maverly was debited. And when we say you debit an account, it means you place the information on the left side, using the corresponding item as the detail. Same thing applies for returns outwards. That was credited. And when you credit an account, you place the information on the left side, using the corresponding account as the corresponding item rather as the detail. Okay? Now this wraps up double entry, the asset of stock. I must remind you that you must keep at the forefront of your mind the concept of double entry, what it is, how it works, T accounts, what they are, how they were, the debit side, the credit side, the double entry rule. Keep all those things in mind. Don't forget them, because as we progress, you will be required to recall those knowledge, or that knowledge rather. Okay? Now, in next week's lesson, we will be looking at double entry for revenues and expenses. During this week, feel free to do a little reading if you so desire. But remember, keep double entry in the forefront of your mind. Okay? If you enjoyed that video, please subscribe, like, comment, and share. And also, click that notification bell so that whenever I upload new videos, you will be the first to know. And as always, if you have any questions, queries, or concerns, feel free to share them in the comments section below and I will respond to you directly. Until next time, walk good, stay safe.